We are going to start Chapter 7, which is accounting for plant assets. Businesses own a variety of different assets, cash, other things that are consumed within a year. Those items are called current assets. And again, these are used or consumed within a year. Supplies, insurance, things like that. And then there are other assets that are a little bit bigger, like land, building, equipment. And these can be called plant assets, which is what we call them in this book. Or they could also be called fixed assets or long-term assets. Okay, and these are greater than 1 year, multi-year uses. Okay, you're not going to use a truck for 1 year. You're not going to use a building for 1 year. You're going to use that for multiple years. Okay, and so we are going to record these assets. And then we're also going to work on depreciating the assets. Because, you know, when you buy a car and you drive it off the lot, as soon as you drive it off the lot, it's not worth as much as what you just paid for it. Okay, that's depreciation. And so what we want to do is we want to record depreciation over several years, the cost of that vehicle over several years, and not put it all into 1 year, because that kind of skews our expenses for that year. Okay, so initially we just want to record the cost of the purchases. The cost can include other things like the transportation, the delivery fee, it could be the setup. If it's something that has to be welded together, the cost of somebody coming out to weld it together, things like that. Okay, any installation cost. Okay, so the cost of that would all be included in this for our purpose. All right, so let's see. Actually, looking at our problem for working together 7-1. We have Kilgren Corporation depreciates all plant assets using straight line method. Okay, and so we'll get to that and what that is. Plant asset records, a general journal, and a cash payments journal are provided in the working papers. Then we have our source documents, we have our transactions. It gives us account numbers for land, building, office equipment, and warehouse equipment. And so what we have here is we've got a cash payments journal, we've got a general journal, we have plant asset records, and we're actually going to do 7-1 and 7-2 together. And then I don't need those. Pull those out. And then we'll have our depreciation tables that we'll look at as well, because we're going to look at purchasing them and depreciating them in this video. Okay, so our first transaction is that we paid cash for a printer, which is plant asset number 321, for $840. There is no estimated salvage value. The estimated useful life is 3 years, and we've got serial number information and check 610. So some of that we need for depreciation information. Okay. So we bought it with a check. So cash payments journal. And this is let me see if it's all supposed to years. We're going to look at years a little bit differently. Yeah, journalize the transaction is completed during 20X1. So we're going to, instead of putting 2018, we're going to use this 20X1. and this is January. And this just helps us when we're trying to understand the depreciation over multiple years. This is year 1, year 2, year 3, year 4, that kind of thing. Okay. This printer, if we look at the different accounts, okay, we've got land, building, office equipment, warehouse equipment. So a printer would be office equipment. And it was check number 610 for $840 in our cash credit. Okay. Also, when we purchase this, then we need to basically have a document where we can track the information. So there's a plant asset record right here. And so this is, we're just going to fill out the top part for the printer. So plant asset record, it tells us number 321. Okay, and again, this would just be something we put into a file, but it gives us information about that product. Okay, it's a printer. The account number for office supplies is 1230. That was given to you in the instructions. And that account is office equipment. The date bought was January 3rd of 20X1. We've got a serial number B0634BRE. The original cost, $840. Estimated useful life, 3 years. Salvage value, 0. And the depreciation method, straight line. Okay, so this helps us with information that we'll need for calculating depreciation a little bit later, and then you can see that there's a section here for when we dispose of it and we're ready to get rid of it. Okay, so this is one record for a plant asset that we have acquired. Okay, so let's go back. And our next purchase is bought a conveyor table on account from Packing Systems, and it gives us all that same information again. Okay, so a conveyor belt, building, office equipment, warehouse equipment, or land? What do you think? I hope you would say warehouse equipment. It was bought on account, so we didn't pay cash for it. All right, and so we're going to put it into the general journal. It's not going to go into a purchases journal because we're not purchasing merchandise. So this company, or the way we do it in this book, and it may not always happen this way, but this general journal is when we buy something on account other than merchandise. So we're going to buy on account that's not merchandise. Okay, if we were buying merchandise on account, we would go put it in our purchases journal. Okay, but we want to keep that kind of separate from this. So this was on April 5th, again, 20X1, April 5th. We bought this warehouse equipment. It is Memo 67. We bought it for $1,800. Okay, and it's an accounts payable to Packing Systems. Okay, so now again, we've made a purchase. Let's turn over fill out a plant asset record for that purchase. And again, all this information comes from your transaction. So this is 326. The description is that it's a conveyor table. Warehouse equipment. And that account number is 1240. The date bought was April 5th, 20X1. The serial number is HE26 3464. Original cost $1,800. Useful life, they think they can use it for 5 years. Okay, and see the estimated. Okay, we don't know. It may last more than 5 years. It may break down in 3. Okay, but from previous knowledge and maybe the company that we bought it from, they're going to estimate that it'll be working equipment for 5 years. Also, there's a salvage value. So they're saying at the end of that salvage value, we think it'll be worth $200. Okay, it'll be worth $200 to somebody else, or maybe a scrap metal, who knows. But we'll think after 5 years, it'll be worth $200. And then straight line is our type of depreciation. All right, so there's that record for that one. And then our next transaction is that we purchased a warehouse for $300,000. The building was appraised for $240,000 and the land for $80,000. The building's useful life is 25 years, estimated salvage value $25,000. Plan asset number, okay, a number for each one, and then a check number. Okay, so what you need, so we need to break this down into what's building and what's land. Okay, and so they give you some information where the building is worth $240,000, and this is some appraiser coming in telling us the breakdown of this, and the land is $80,000. Okay, and so that total is $320,000. Okay, so what percentage of this total is building and what percentage of this total is land? So I'll just do the math. So 240,000 divided by 320,000. Okay, so that's 0.75. So this is 75%, and this is 25% of that value. Okay, so now we can take these percentages and apply them to the 300,000 that we actually paid. Okay, we got a good deal on it. So 300,000 times the 75%. So that we're saying the building's going to be worth 225,000, and the land is worth 75,000. Okay. All right. So even though these are two different items, we bundled them together. We paid for that price. But good accounting practice says we break those down. Now I'm going to tell you that international standards will have you break things down even further. So like if you were to buy a truck, then you would have to break it down into the transmission, the engine, the tires, and so forth. Okay, the GAAP principles don't necessarily ask for that much of a breakdown. All right, so now we have our numbers. And on October 8th, we've got an account for building, and we have an account for land. All right, so the building is worth the $225,000, and the land is worth $75,000, and we paid $300,000 for it. And what was the document? Check number 920. Okay, so that's recording the purchase of the building and land. And then we need to do the plant asset for each of them. All right, so this is a warehouse. So plant asset record 341. A warehouse. Building is the account title. 1220. The date bought was October 8th. 20X1, the serial number. Buildings don't have serial numbers, so it's not applicable. The original cost, again, just the portion for the building. Useful life. Okay, again, estimate, 25 years. Estimated salvage value after 25 years. We still think just the building will be worth $25,000. And we're going to straight line the depreciation. Okay, and then we're going to fill one of these out for land. But we don't depreciate land. Land seems to be something that actually will appreciate, and so we'll just wait until we sell it to see how that changes. So we don't ever try to depreciate the land, but we will depreciate the building. And the way to keep a building from not depreciating in so much is to do improvements on it. Okay, so no estimated life, no salvage value, and no depreciation method. Not applicable. Okay? If you want to put a note on here, we don't depreciate, not appreciate. Don't depreciate land. Okay? Now actually, here's this little area where, there we go. These kind of calculations could have actually happened. Building, 240, 80, 320, 75%, 25%. Okay, so the assigned cost is the 225 and the 75,000 gives us the 300,000. Okay. All right, so they gave you a place to do that. It was just on the wrong side of what I was trying to work on. All right, so we've done the journalizing and we've done the first part, the top part of the plant asset record. All right, so now we're going to actually get into the depreciation. So there's several ways to depreciate. And the first one we're going to look at is a straight line. It's pretty simple and straightforward. All right, so the first thing we're going to do is complete the depreciation table for each asset using straight line. If the asset was not purchased at the beginning of 20X1, compute the depreciation expense for the part of the year that the asset was owned. Okay, so let's look. This is almost for depreciation tables. All right, so this is kind of another part of what we do when we buy a plant asset. We journalize it. We create a plant asset record, but we're also going to complete a depreciation table for it. and we'll need, well, they gave it to us. This is the information we need that may have come from the plant asset record, and I think luckily they've given it to us. Okay, so for our printer, it was straight line depreciation, the original cost, if there is a salvage value, and for how long. All right. And then let me give, let's see, salvage value. We've got salvage value. Just some other terminology for salvage value is residual, scrap, or trade-in. And again, our books, so we can always use salvage value, but in other books, companies, you may hear any of those terminologies. And remember that this is an estimate. Okay, it's estimated useful life, estimated salvage value. Okay, and it's a good idea that these tables are completed at the time of purchase. Okay, and there are whole departments that work on this stuff. I know when we went on the field trip to BD Medical, they had a whole department that just work on plant assets and depreciation and doing all the accounting work just for the bigger equipment and trucks and buildings and things like that. All right, so book value. Book value is the difference between the cost and the accumulated depreciation. Okay, so we're going to figure out what the depreciation is for each year that we have the asset, and then we're going to keep a running total of that depreciation. Okay, and so the difference between the original cost and the accumulated depreciation is your book value. Okay, and that's the value of your asset at that time during that year. Okay, because your asset's going to decrease in value each year. All right, so for year 20X1, okay, and we need to think about when we bought it. Okay, so we bought this in January. Okay, and so we're okay. We're going to use the whole year for this depreciation table. So the beginning book value is the original cost. So the $840. Okay, now with straight line depreciation, basically you take the value of the plant asset or the original cost minus the salvage value. Okay, what's it going to be worth when we're done with it, and then divide that by the number of years. Okay, so we're going to do 840 minus 0 divided by 3. Okay, so 840 divided by 3 is 280. So every year our printer is going to depreciate by $280. All right, so again, this is keeping a running total. So for year 1, 280 is our accumulated depreciation. Our ending book value for this year is the beginning minus the depreciation to get the ending. So 840 minus 280 is 560. Okay, the ending book value for 20X1 is the beginning book value for 20X2. Okay, so the depreciation table is going to do the entire depreciation for the life of the asset. And then this just goes on file, and we can reference it each year as we need to do the depreciation expense. All right, so 560 is our new value for the printer. Again, it's going to depreciate for $280 this year. Okay, so the 280 plus 280, okay, plus equals 560. Okay, and then 560 minus 280 gives us 280. The ending book value is the beginning book value for the next year, so 20x3. Okay, again, depreciation is the same. That's what straight line is. It's the same every year. Okay, and then 280 minus 280 is 0, and 560 plus 280 is 840. All right, so this works out perfectly where after 3 years, or end of our useful life, we have a salvage value of 0, and we end up with 0 here. So it's all worked out. Okay, now we may keep the asset longer than that. Okay, and that's just kind of a bonus benefit to us. We don't have to get rid of it after 3 years, but it's not worth anything as an asset on our books any longer. Okay, so now to the conveyor table. The conveyor table, if you look back, we bought in April. Okay, so in year 20x1, we did not have it for the entire year. You have to think about that. Okay, and then we need to figure out what our annual depreciation is going to be. Okay, so it's going to be 1,800 minus the salvage value, which is 1,600, divided by the number of years. Okay, so that's $320. All right, but in year 1, we can't use all $320 because we didn't have it for the whole year. Right? So we're just going to put a little 320 out here just so we know. All right, so then 320 divided by 12 is $26.67 basically, times however many months we did have it. So we had it for April, May, June, July, August, September, October, November, December, 9 months. Okay, so that number times 9 gives us $239,999. We're going to keep things simple, and we're going to round that to $240. Okay, so if you need to know how you got this $240, we took the 320 divided by 12 equals it was like 12, it was at 26,66666 times the number of months, which was 9, and that's April through December. Okay, and again, for this purpose, we're not gonna go into pennies, so just round. Okay, and keep it simple. All right, so there's our 240. So beginning book value, 1,800. Okay, 1,800 minus the depreciation gives us our ending book value of 1,560. Okay, accumulated depreciation is my running total. So right now it's just 240. Okay, ending book value is beginning for 20x2, so 1,560. Now, the rest of these years, until maybe I get to the end, are 320. We did that calculation. Okay, because now it's a full year. Accumulated depreciation, this plus this, so that's 560. Okay, ending book value, this minus this, gives us our new 1,240. Let's see if we could write, just so you know, this minus this equals this. Does that help? Remember, these are notes for you guys, so write in whatever helps you. Remind you how to do this. All right, 20x3. We're going to try to do this for 5 years and see where we are. All right, so for 20x3, we're at 1240. 320 is our constant straight line. 560 plus 320, 880. 1240 minus 320, 920. Okay, now beginning of 20x4, 920, 320 stays constant. Okay, 880 plus 320 gives me my running total, my accumulated depreciation, and then 920 minus 320 gives me my new book value for 600. 20x5, I've got 600. Okay, I'm still not down to my 200 yet, right? My product is, my plant asset is still worth 600, so I'm still depreciating. 320 accumulated depreciation. This plus this is 1520. This minus this is 280. Okay, now I've gone my 5 years, but I haven't gone. Actually, I haven't gone a full 5 years because I started in April, right here. Okay, so there's going to be a little bit going on in 20x6 because of that. All right, so I know that my salvage value is 200. Okay, so I'm only going to depreciate $80. So I just got to get from 280 to 200. Okay, I'll go ahead and bring that over here. That would make more sense. 280 minus 80 gives me 200. 1520 plus 80 gets me 1600, which matches up the 1800 minus the 200. Okay? All right. And then for the warehouse, make a note here. This one was bought in October. And we'll start with 20x1. Okay, and so we've got to figure out again, what's it worth? We're just October, November, December, right? So this is 3 months. This was 9 months. Okay, and that was the whole year. So this is only 3 months worth of depreciation, right? So the original cost, I'm not sure why they didn't put it in there for us, but, oh, they didn't want to give you that answer. So $225, we figured that out using our percentages. So that's our beginning book value. And then again, we're still straight line depreciation, and we have a salvage value. So 225 minus 25,000 gives us 200,000 divided by 25, and that's 8,000. Okay, so our depreciation is 8,000 for the entire year, but we're only looking at 3 months here. So we're going to divide by 12 and times 3. Okay, so that number is important, and then this number will be important. So 8,000 divided by 12 times 3, again, gives me a, wait, I didn't get it all done. 200,000. Did I do that right? 200,000 divided by 12. No, 8,000. Oh my goodness. Divided by 12 times 3. Okay, gives me a 1,9999.9999. We're going to make it easy. It's going to be a straight 2,000. Okay, so for the first year, 2,000. We're starting off with our depreciation here. Subtracting 223. Okay, and then 20x2. Okay, 223 is our ending for one, so it's our beginning for the next. Now we're going to do 8,000 a year. Okay, so now our accumulated depreciation is 10,000, and 215 is our new book value. Okay, So you would continue that for 25 years, okay? Now, and you're going to need to continue that for as many lines as are listed here, okay? So you would need to go ahead and keep going all the way through this. For time's sake, I'm going to go ahead and move on. The next thing it wants us to do is to complete the plant asset record for 20X1 through 20X4. So now we're going to go back to the plant asset records in 7.1 that we created. And what we would actually do, let's see, there's land, warehouse. I gotta find them. Printer, conveyor table. Here we go. Okay. Is we're gonna use this information because we've already got this done for us. It's in a file. We go pull that file. We do the depreciation for the year. We're gonna do this for multiple years, but in reality, you would just pull this record at whatever time you're doing depreciation, and you would fill it out. For 20, if this is 20X1, okay, we'll fill it out. And then a whole year later, we'll come back in and we'll do 20X2. And a whole year later, we'll come back in and we'll do 20X3, okay? So for classroom purposes, we're going to do all this at the same time, just so you can see it. But in real life, this would only happen once a year. Okay. So, printer. Okay, so for the printer, 20X1, what we're looking for is the annual depreciation expense. So that's this. This column is our expense, basically. Okay, so that's going to come from here. Accumulated depreciation, of course we've got that as well. And ending book value, 560. Okay. We don't have the beginning book value on here at all. Again, 280. Again, we're coming back. This is a whole year later. Accumulated depreciation, 560. And ending book value, 280. And 20X3, 280. 840. And 0. Okay, and so we're done. Even though it said to do it to 20X4, we can't because this one wasn't estimated to last that long. Okay, so again, really, the nice thing about doing these tables when you get the asset is that it's already done. So now you're just coming in. You don't have to worry about all the calculations again. You're coming in to complete this. And then what you would do is you would actually, like in 20X1, okay, you would do this, and then you would actually go and journalize it. 7.2 general journal. There we go. Okay, and depreciation is an adjusting entry. So it's going to happen on December 31st. All right, and the printer is office equipment. So this, your accounts, depreciation expense. This is an actual account in your chart of accounts, office equipment. And accumulated depreciation for office equipment. Okay, so again, we're keeping track of our expense, running total, and then we're also keeping track of all of the depreciation. All right, and then, so this is 280. Okay, and then, so for the warehouse, where's my warehouse? There's a lot of papers. There's the warehouse. And the conveyor table, I guess we need that one too, don't we? Oh yeah, conveyor table's next, actually. So conveyor table. Where's the conveyor table? Right there. Okay, and then I'm looking for my depreciation table. Or the conveyor table. All right, so 20x1. Okay, depreciation for year 1 was 240. Accumulated depreciation 240. Ending book value 1560. Okay, and then really, the next thing you would need to do. Gosh darn it! Again, too many papers. There we go. On December 31st of 20x1, this is all 20x1, we do the depreciation expense for that warehouse equipment. Okay, and the accumulated depreciation for warehouse equipment for 240. Okay, and that takes care of that one for 20x1. And then they're asking us again to do this through 20x4. Okay, so you would need to go ahead and do those as well. Just make sure you read your instructions so you know what they're asking you to do. And then the last one I think is the warehouse itself, which is the building. So let me find the plant asset record for the warehouse. Okay, and the year 20x1 depreciation was $2,000. Okay, ending book value being 223,000. Okay, and then we would journalize that. Again, depreciation expense for building and accumulated depreciation for building, and this one's 2,000. Okay, now that's all the 20x1, and then, like I said, they are asking you to go ahead and complete this for 20x2, 20x3, and 20x4. Okay, and again, that information is coming straight off of your plant asset records that you have. You don't have to redo any calculations. Excuse me, not your plant asset records, your depreciation tables. That's all that math's already done, so you're just pulling it off and replicating it there. Okay? So really that takes us through 7172, which is buying assets and then depreciating those assets over multiple years. Okay? And then we'll do another video for 7.3, which is getting rid of assets. What do you do when you're ready to sell them or trash them or whatever? And then we'll talk about some different kinds of depreciation methods besides just straight line in 7.4. And those will be a couple other videos. All right. Good job. Keep it up.